This video gives an overview of the accounting for leases and the related financial statement notes. Leases are rental-type agreements that have characteristics of both executory contracts, such as paying for services and labor, and financed purchases of assets. When we consider the accounting for leases, we also need to think of the types of contracts we're accounting for. Different types of leases convey different legal rights and have different tax impacts. Accounting rules, bankruptcy rules, and tax rules all have criteria that distinguish whether they treat a lease as a de facto purchase. Accounting rules use the term operating lease to refer to what we normally think of as a lease or a rental agreement. Finance leases are treated as a debt-financed purchase. Operating leases result in rent expense on the income statement, usually straight line, and the payments flow through cash from operating activities. Companies must also recognize a liability for future lease payments and an asset that represents the right to use the leased asset. A finance lease is treated like a loan, where the payments are accounted for like debt and the asset like PP&E. This results in interest expense from the loan and depreciation expense from the PP&E. The principal portion of payments flows through cash from financing activities, and the interest portion flows through cash from operations. For bankruptcy purposes, true leases are analogous to operating leases and are treated as rentals, whereas a secured interest is analogous to a finance lease and is treated as a loan. With a true lease, courts treat the asset as the lessor's. In bankruptcy, the lessor can reclaim the asset if the lessee is unable to work out a satisfactory agreement to continue making payments. For example, the lessor of office space can evict a tenant and find a new tenant. With a secured interest, the transaction is treated as a loan. In bankruptcy, the lessor's claim to the asset is subject to the bankruptcy settlement. Based on my own research, this is the most important driver of leasing. Financiers are much more willing to provide capital when they have the protections afforded by true leases. Similar to the bankruptcy classifications, tax rules have a true lease classification that is treated as a rental, and a conditional sales contract is the tax analog to a finance lease. Accounting, bankruptcy, and tax rules have similar criteria for distinguishing whether a lease is a rental-type lease or a de facto purchase. They all consider whether the asset will likely transfer to the lessee. They also consider the lease term, or the lease value, relative to the asset's life or value. Accounting rules also have a criterion for assets with no alternative purpose, such as specialized factory equipment. Typically, an operating lease for accounting purposes will be a true lease for tax and bankruptcy purposes. Indeed, the reason why the lease is an operating lease is because the financiers wanted a particular legal treatment of the lease. To illustrate lease accounting, let's work with an example where the entrepreneur Lando Calrissian wants to lease Cloud City from the evil real estate mogul Darth Vader. The lease covers 3 years. It calls for an upfront in-kind payment worth $600 and then $700 per year for the next 3 years. At the end of the 3 years, Cloud City will not have economic value, so this qualifies as a finance lease. We will account for the liability as a debt and the asset as PP&E. If Cloud City is worth $1,800 at lease inception, then the lease liability is the $1,200 difference between the $1,800 and the initial $600 payment. To get the interest rate, we match the $1,200 initial liability to the $700 annual payments to obtain an implied interest rate of 34.2%. Apparently, the Empire charges high interest rates. The interest expense will follow the standard effective interest method used for debt. The asset is worth $1,800 at inception, which gives annual straight-line depreciation of $600. Note that the interest expense declines over time as the loan balance decreases. The straight-line depreciation and the front-loaded interest expense result in a total expense that declines over the lease's life. This illustrates how we account for a finance lease. Now suppose that the Empire decides not to destroy Cloud City at the end of the lease's life, but instead takes it back from Lando. Because the lease no longer accounts for Cloud City's useful life and there is no bargain purchase option, this will be an operating lease. The liability is the same under the operating lease treatment and equals the present value of future payments. The operating lease results in rent expense that is spread evenly over the lease period. The total cost is the $2,700 total of the payments, which gives lease expense of $900 per year. Unlike the finance lease that has depreciation and interest expenses, the rent expense appears as one line on the income statement and the cash flows are all treated as operating cash flows. Given the flat rental expense, an interest expense that we need to maintain the liability amount, the depreciation expense is a plug for the rent expense in excess of the interest expense. Notice that this results in a weird decelerated depreciation expense with higher depreciation in later years. To wrap up the example, this slide shows the impact of the leases on the financial statements. Regardless of the accounting, the leases result in $2,700 of cash outflows and $2,700 of expenses. The accounting treatment affects only the timing and the classification of the expenses and cash flows. The finance lease works like a PP&E purchase. The initial payment is an investing activity, the principal payments are financing activities, and the interest payment is an operating activity. The asset depreciates at straight line, while the interest expense is front-loaded due to the effective interest method so that the overall expenses are front-loaded. The operating lease classifies the cash outflows as rent, which impacts cash from operating activities. Likewise, the expense is a rental expense that reduces operating income. The straight-line overall expense, combined with the front-loaded interest expense, results in back-loaded depreciation, which we see on the balance sheet where the asset depreciates more slowly with the operating lease. Having seen the accounting for leases, now let's look at how leases affect financial ratios. We use data from Fastenal, whose primary operations involve the distribution of industrial fasteners. We'll look at three ratios: debt to equity, return on assets, and return on equity. Then we'll look at the DuPont decomposition of return on equity. The debt to equity ratio divides debt by equity, which equals 0.148 for Fastenal. If we wish to treat operating lease liabilities as debt, then we add them to the numerator of the debt to equity ratio, giving debt to equity of 0.238. It is leverage ratios such as debt to equity that typically see a large impact from treating operating leases like debt. Return on assets and return on equity don't vary with how we classify operating leases, so the ratios with and without lease adjustments give return on assets of 22.1%, and return on equity of 31.8%. For the decomposition of ROE, we first need to compute NOPAT. We can use Fastenal's 24.2% effective tax rate when computing NOPAT and after-tax interest. The tax rate reconciliation in Fastenal's tax footnote shows nothing unusual in the 2020 ETR. We then apply the ETR to operating income and interest to get the after-tax values. Now that we have the income statement items, we can look to the balance sheet to compute return on net operating assets. To compute the denominator for return on net operating assets, we can either compute the net operating assets or we can compute the net capital. This gives us RNOA of 30.2%, which is the first component of the ROE decomposition. For the impact of debt, we need the average debt to equity ratio and the spread between RNOA and interest expense. For the impact of cash, we need the average cash to equity ratio and the spread between interest income and RNOA. Putting the pieces together, we see that RNOA is 30.2%, which reflects the performance of Fastenal's operations. Debt adds 3.9% to ROE because Fastenal is borrowing at an after-tax rate of 2% and investing it in operations that earn 30.2%. Cash subtracts 2.3% from ROE because of Fastenal's investments in low-risk cash investments with a correspondingly low after-tax return of 0.2%. To compute adjusted metrics that treat operating leases as debt, we need to include operating lease liabilities with the debt. We also need to reclassify some of the rent expense to be treated as interest expense. For this, we'll take the approach used by Standard & Poor's. Specifically, we estimate the interest expense by multiplying the average lease liability by the 2.4% implied lease interest rate, which Fastenal discloses in the notes to its financial statements. After adjusting for taxes, the estimated lease interest is $4.5 million. We add the $4.5 million to NOPAT and add the operating lease liabilities to net capital to get a revised RNOA of 28%. This is the first building block of our ROE decomposition. We add the operating lease liabilities to debt to get a revised debt-to-equity ratio and a revised interest rate. The impact of cash will be similar to the unadjusted numbers, except that the revised RNOA will change the spread. Putting the pieces together, we see that RNOA is 28%, which reflects the performance of Fastenal's operations. Debt adds 6% to ROE because Fastenal is borrowing at an after-tax rate of 1.9% and investing it in operations that earn 28%. This is higher than with the unadjusted numbers because the leverage is much higher when we treat operating leases as debt. Cash subtracts 2.2% from ROE because of Fastenal's investments in low-risk cash investments with a correspondingly low after-tax return of 0.2%. The ROE is 31.8% whether or not we adjust for leases. The difference is that if we view the operating leases as debt, then a larger portion of the ROE comes from leverage rather than from operations. This is typically the case when comparing unadjusted versus lease-adjusted numbers. Summing up, when you want to treat the operating leases as debt, the balance sheet adjustments are straightforward. You simply treat the lease liability as a part of net capital rather than as a part of net operating assets. The income statement requires you to make an adjustment for implied interest, which is because companies do not separate interest and depreciation expenses for operating leases, but instead have a single rent expense. The last point I want to cover in this video is how to incorporate leases into your assessment of a company's financial risk. My own research shows higher bankruptcy risk amongst companies with a relatively high proportion of operating leases in their capital structure. This is because operating leases give financiers more legal protection than debt in finance leases, which is especially valuable when dealing with risky companies. Fastenal's December 2020 balance sheet shows that leases are 7.2% of its gross capital, which does not net out cash, and 7.8% of its net capital. For a comparison point, I use Capital IQ to pull data on companies in Fastenal's industry, limiting to companies traded on major U.S. stock exchanges. Among these companies, Fastenal's leases are more than the median company, but its leases are not major outliers. If Fastenal had high leases relative to its peers, we would want to conduct further analysis to determine whether this reflects high financial risk. This wraps up the video on operating leases. You should now have a good understanding of how to account for leases and how to adjust financial ratios for leases. A great next step is for you to perform some analysis on your own.